Hey guys, so this week, again, in a word, volatility. We've been talking about volatility. Honestly, I can't remember a time that I haven't been talking about volatility. I'm getting tired of volatility. I would like smooth sailing. And I'm hoping sometime soon we're going to talk about smooth sailing in the markets where we have some predictability. But we did predict some of this bumpiness or whipsawing back and forth. Some days you've got rates that are up, some days you got them way down. And we got to be really careful. We got to be vigilant and understand when people are shopping for rates. If they're shopping on Tuesday and then they shop with somebody else on Thursday, they may not be on this even playing ground. They really need to make sure, your buyers have to make sure if they're shopping, that they're shopping with lenders all in the same day, and preferably all within the same few hours, in fact, because if you shop in the morning and then we get intraday moves that can be, again, whipsawing up and down in big chunks. We got to be really careful. This past week, though, we had a bond auction, a couple of bond auctions. We had a 30-year bond auction. We had a 10-year Treasury bond auction. And basically what happened, that nobody showed up. There was nobody buying. So essentially the bonds sold off. And that's not good for interest rates. So mortgage rates, took off a little bit. We also had the CPI report that came out. That was actually not as bad as we were expecting. Not that we were expecting it to be bad, but the reality is we knew that the year-over-year numbers weren't going to be as favorable as some of the months that we've seen in the past, in the recent past. In the next couple of months, we're anticipating some of those year-over-year numbers to be very favorable. But this particular report, not as much, but gasoline and energy costs seem to be coming down. It may not feel like it, but overall, those are in our favor. The core readings are declining. So if you look at the macroeconomics, we are starting to see inflation, actually we've been seeing inflation drop. And we've talked about this before. The Feds they don't seem to understand lagged economics. Everything that they do impacts, and monetary policy impacts what happens 5, 6, 9 months down the road. And the reality is they don't seem to understand it. Mary Daly this past week in the San Francisco office kept talking about how they got to continue to work and get that inflation down to 2%. And again, we've talked about this. It's asinine to think that they think that way. People in their own office actually don't agree with them, and so there's some infighting there with comments of what a lot of them say. So again, what do we say? Forget about the noise. Stop paying attention to the noise. Don't pay attention to the headlines. Pay attention to the fundamentals and what we see and what we know is going to happen based on those fundamentals. The reality is, we've talked about this before, 10-year Treasury, 2-year Treasury, inverted. What happens every time that happens? Mortgage rates drop every single time. There are several indicators that tell us and show us that long-term rates are going to be going down. So we know in the next 3, 6, 9 months are going to be very much in our favor. So we've got to just be patient with some of that. Understand that the demand that is there today is just going to continue to rise. We saw a report last week that showed that appreciation in housing is expected to continue at a rate somewhere between 5 and 7%. Okay, so what does that mean? Well, what it means is if somebody's on the sidelines and they're waiting for interest rates to come down, their acquisition costs are going to continue to rise. And not only are they going to miss out on such a discount that they would get today, it may not feel like a discount, but it will be a discount 6 months from now. They're going to miss out on that discount, but now they're going to have to compete against 8, 10, 12 more people looking at the same house, where that competition may not be as severe today. So again, let's talk to our buyers, let's talk to sellers to take advantage of that. The reality is that it's always a good time to buy a house in the long run. And for those that are waiting on the sidelines for interest rates to drop, may be missing out in terms of acquisition cost increases over the next 6 to 9 to 10 months. Next year, it's going to get really crazy, especially if interest rates drop into the 5% handle. There's going to be a lot more people coming into the market, and a lot of people waiting are going to wish that they hadn't done that. So, hey, let's get together. If you are wanting to grow your business, let's talk about leverage. Let's talk about strategy. And those two things combine into success and more listings and more buyers and more transactions for you. Let's work together. Let's talk about how we can help you get more transactions, get more listings in this market. Winter's coming, but we want to get more and more people in front of you as a real estate agent so that we can help you and we can help each other grow as we get to 2024. You guys have a great weekend.